Whenever somebody tells me dollar cost averaging is dead, I know two things immediately. First, they are trying to shock you. Second, buried inside the shock is usually a real structural truth that deserves much better language. Dollar cost averaging is not dead. It still does what it has always done for ordinary people. It lowers behavioral risk, imposes discipline, and lets a person steadily accumulate ownership in productive assets without needing to pretend he can predict every turn in the market. That matters. It matters a lot. If you spend 30 years buying broad, low-cost exposure to good businesses and you avoid doing anything spectacularly foolish, you will probably do better than most people who keep trying to sound clever. I have no interest in insulting that. But there is another truth sitting right beside it, and this is the one almost nobody explains. Honestly, dollar cost averaging into a public index is increasingly a strategy for protecting and compounding what you already have. It is no longer the full story of how the largest fortunes are usually formed. That is the part that makes people uncomfortable. They were told the public market was the whole game. It is not. It is still an important game, a necessary game. For many people, the right game. But it is no longer the whole field. And if you do not understand how the field changed, you can spend decades doing something sensible and still wake up wondering why the richest people seem to be getting rich in a different movie than the one you were shown. The first thing you need to understand is that the market is not the same thing as the economy, and it is certainly not the same thing as where all the best upside begins. People say they buy the market as though they were buying the full productive engine of American capitalism. That used to be a more defensible simplification. It is less true. Now, because when you buy a big public index today, you are not buying some beautifully even spread of 500 equal engines all pulling your future forward. You are buying a structure that has become heavily concentrated in a handful of dominant names. While a vast amount of entrepreneurial growth now stays private much longer than it used to, that is the change, and it is not a cosmetic change. It changes the return path ordinary investors are being offered. The concentration problem is the easiest place to start because it is the most visible. A broad index still contains hundreds of companies, yes, but in practical weight, a surprisingly small group now drives a very large share of the outcome. S&P Dow Jones Indices has noted that by mid-2025, the 10 largest companies in the S&P 500 represented almost 40% of the index, a level of concentration not seen since the mid-1960s. Fay turn 792,360 search 0 Fay turn 792,360 search 8 Fay. That does not mean those companies are bad. Many are extraordinary. It does mean the emotional story people tell themselves about diversification is often much tidier than the reality. If 10 companies are doing that much of the lifting, then owning the whole market increasingly means owning a very large bet on a very small set of giants, with several hundred smaller names riding in the sidecar. Maybe that works magnificently for another decade. Maybe some of those giants keep compounding and deserve every ounce of their weight. But it is not the same thing as broad economic ownership in the way people casually imagine. And whenever a public strategy begins depending heavily on a handful of giants, the investor should at least admit what game he is now playing. He is no longer just buying the quiet average. He is buying concentration wrapped in the language of diversification. That is not necessarily bad. It is simply different. And if you do not name it correctly, you cannot think clearly about what it means. The second thing you need to understand is even more important. The public market shrank as a gateway. For many years, ordinary investors were told a comforting story. Build your income, save your money, buy the public market, and you will participate in the great growth engine of the country. That was always incomplete, but it has become more incomplete over time. The number of listed domestic companies in the United States has fallen dramatically from the heights reached in the 1900s. The World Bank S-Series on listed domestic companies shows the count is far below the late 1900s peak. Fay turn 736,467 search 0 Fay turn 792,360 search 9 Fay. Why does that matter? Because a shrinking public universe means you are increasingly being handed a more selective, later stage, more mature slice of corporate life. In the old story, many exceptional companies came to the public market earlier in their growth arc. Ordinary investors could own them through a large part of the climb. Now, a great deal of that climb happens before the ticker ever reaches the public. The company stays private longer. Venture capital gets the early growth. Private equity gets the restructuring and scaling phase. strategic investors, insiders. And institutional pools absorb the fat middle of the upside. Then, much later, the ordinary investor is invited to admire the opportunity. At that point, he is often buying a business that is already large, already expensive, already optimized for institutional exit, and already far along the arc that used to create the life, changing multiples. That is not cynicism, that is sequencing, and sequencing matters in wealth. Most of the greatest fortunes are made not by owning things after the world agrees they are important, but by owning them while the world still treats them as local, boring, misunderstood, or operationally messy. The public market is much worse at giving ordinary people that kind of entry than it once was. That is why I do not like the lazy sentence. Just buy the index and you are buying America. You are buying part of public America. You are buying the older, filtered, already listed layer of it that can still be wonderful. It is not the same as buying the earliest and richest formation stage. This is where the wealthy have been playing a different game for years. Not because they are smarter by birth, because they have access to ownership structures the average salaried investor never gets taught to look for. They own private businesses. They buy into operating companies before the public market ever sees them. They fund management buyouts. They acquire boring, cash-flowing firms in unglamorous sectors. They partner into deals where value is created by fixing, tightening, professionalizing, or simply holding productive local businesses that the public market will never price for them. This is what so many ordinary investors miss. They think private markets are only unicorns, rockets, and celebrity venture rounds. That is the cartoon version. The real private market is much larger and much duller than that. It includes plumbing companies, distribution businesses, HVAC shops, medical practices, regional services, niche manufacturers, logistics operators, recurring revenue service firms, and all the other quiet machines that keep the country functioning, whether CNBC talks about them or not. And there are far more of those businesses than there are public companies. The U.S. Census Bureau said that in 2023 there were 36.4 million U.S. employer and non-employer businesses, and separately reported roughly 5.9 million employer firms for 2022. Phasite Phaeturn 736,467 search, 7 Phaeturn 736,467 search, 14 Phay. Most of them will never be in an index fund. Most of them will never have a ticker. Most of them will never ring a bell on an exchange, and yet many of them will throw off wonderful cash flows, support families for decades, or eventually become the sort of local or regional assets that quietly make their owners rich. That is the part of the economic landscape ordinary investors are trained not to see. They are shown the stock app and told that is the playing field. It is not. It is one playing field, and increasingly it is the playing field where later stage ownership gets distributed after much of the richest growth has already been internalized somewhere else. This is why I do not think the right conclusion is stop dollar cost averaging. That would be silly. The right conclusion is more mature. Understand what DCA is excellent for, and understand what it is not designed to do. It is excellent for discipline, excellent for retirement compounding, excellent for making sure your savings do not rot in cash, excellent for the person who has no edge in security selection, no appetite for operational risk, and no desire to spend his weekends studying local business economics. There is no shame in that. In fact, it is often the wisest course available. But if you think it is the full map of how major wealth gets built in the current environment, then yes, you are missing something important. The field moved. The best players noticed. The rest are still quoting the old rule book. A great deal of this shift happened because it became less attractive to be public and easier to stay private. Founders are not stupid. They know that public listing means quarterly scrutiny, legal overhead, investor relations theater, compliance burdens, public embarrassment when a quarter disappoints, and constant pressure from people who can buy a small position and suddenly insist on redesigning the company they never built. Meanwhile, private capital became abundant. If the old reason to go public was access to growth capital, and that capital is now available privately at large scale, then many founders will reasonably ask why they should volunteer for public life early. That is what happened. The result is structural. The average investor is being invited into companies later at higher valuations with more of the asymmetry already consumed upstream. So if you ever feel as though you are buying polished stories instead of formative businesses, it is not your imagination. Now let us talk about why 2026 matters. Not because there is some magical one-year door that closes forever. I do not believe in fairy tale timing. But the structure right now is unusual in a way that should at least make serious people pay attention. Private equity is dealing with a backlog problem. McKinsey's 2026 Global Private Equity Report says the backlog rose from about 13,000 to 16,000 companies held in portfolios for 4 years or longer globally, with more than half of buyout-backed portfolio companies held for 4 years or longer in 2025. Faysight Fayturn 736,467 search 2 Fayturn 736,467 search 10 Fay. That is not a minor inconvenience. That is inventory pressure. And inventory pressure changes bargaining conditions. When private owners need liquidity, when hold periods stretch, when rates remain higher than the easy money era conditioned everyone to expect, and when the number of businesses waiting for some kind of transition grows, something very important happens. The clean seller's market story weakens. That does not mean everything becomes cheap. It does mean more owners begin thinking about exits, partial sales, seller financing, internal succession, family continuity, management transitions, and all the other practical structures through which patient buyers can gain access. In plain English, deals begin moving from the beautiful theoretical world into the awkward human world. That is where the opportunity often is, not in a spreadsheet fantasy. In a tired owner who is 65, has built a decent business, does not want to hand it to an indifferent financial machine, and cares deeply about price, but not only about price. That kind of seller does not always want the highest bidder. Sometimes he wants continuity, sometimes he wants trust, sometimes he wants to be paid over time, sometimes he wants the company protected from exactly the kind of cold extraction game that private capital has become famous for. Those are not guaranteed gifts. They are not easy. They are simply human conditions. And human conditions create openings that a stock ticker never will. That is what so many people misunderstand about private business acquisition. They imagine it is only for trust, fund heirs and giant firms, writing huge checks. Of course, there is a world of giant checks. But there is also a world of transition deals, operator, buyer models, seller financing, smaller service businesses, and local ownership changes, where skill, seriousness, and credibility matter as much as brute capital. I am not romanticizing it. Buying or operating a business is real work. Due diligence is real. Customer concentration risk is real. Management risk is real. Industry ugliness is real. And if a person thinks he can stroll from index funds into private ownership without discipline, he is a fool. Private business ownership is not a shortcut. It is a different game, a slower game, a messier game, a more human game, but it is also a game where actual control exists and where value can be created by judgment rather than simply rented from market multiples. That is why the rich keep playing it. Not because they dislike public markets, because public markets are where you often store and scale wealth. Private markets are still where a great deal of wealth gets formed. That is a crucial distinction store. And scale versus form, public markets can do both over very long periods. Yes, but increasingly they do the second task more slowly and later in the company life cycle than many people realize. Private markets form wealth by letting people own a thing before the crowd prices the narrative neatly. That is not always glamorous. Very often it is gloriously dull. A boring service business with recurring revenue and old customers may be a better path to serious cash flow than spending 25 years hoping your index fund will eventually save you from a lifestyle it was never designed to subsidize. This is the part where people get angry because they hear an insult hidden inside it. There is no insult. I still think broad indexing is a magnificent tool for most people. I also think most people have been sold a simplified story because it is easier to distribute. Buy the index, wait 40 years, and you will be fine is not exactly a lie. It is just a kindergarten version of capital allocation. It ignores concentration, it ignores late stage listing, it ignores private ownership, it ignores business acquisition, it ignores the fact that a person who owns even a modestly successful private operating company may generate a level of cash flow that would require millions in index assets to replicate safely. That is a very important comparison. People say they want $200,000 a year in retirement income and then calmly accept that the path must be some giant public portfolio accumulated over decades. Maybe it must, maybe that is the right path for them. But if a person owned a few durable cash-flowing businesses, the income mechanics would be entirely different. Again, not easier. Different with more control, more responsibility, more concentration risk, and potentially much more upside from judgment. That is what real capital allocation feels like. Trade-offs, not slogans. So what should a normal, intelligent person do with all of this? First, stop using viral phrases like DCA is dead, as though they explain anything. They do not. Dollar cost averaging is alive and useful. It is just incomplete as a theory of how the entire wealth ladder now works. Second, if you are an index investor, know what you actually own. Admit the concentration. Do not keep using the word diversification as though the market structure had not changed. Own it with open eyes. Third, realize that the shrinking public pipeline and later IPO cycle mean the fattest phase of many companies may occur where you are not invited. That is not a reason to despair. It is a reason to update your mental model. Fourth, understand that there are many more investable, productive lives in the country than the stock market menu suggests. Private ownership is not only unicorn venture, it is also ordinary business transfer. Fifth, if the idea of buying or operating a business interests you, begin learning the language of that world carefully and humbly. Look at listings, read seller notes, study local service businesses, learn valuation ranges, learn what makes cash flow durable, learn what makes customer concentration fatal, learn how financing structures work, learn without pretending you need to buy tomorrow. Sixth, if that world does not interest you, then fine. Use public markets intelligently, save hard, keep fees low, and stop pretending the public market is the entire map. Respect the limits of your chosen lane without becoming ashamed of it. That is the grown-up version of the story. Public markets are where many people should continue to build and defend their future. Private markets are where a great many fortunes still get born. Those two statements can both be true at once. I have always disliked false binaries in money, either passive index funds or aggressive private deals, either safe or rich, either public or private. That is childish framing. The real answer is allocation by purpose. If I need market exposure, liquidity, and scalable compounding, public markets are a wonderful servant. If I am trying to create cash flow, control, and asymmetric ownership through human judgment, private business ownership becomes a different kind of tool. And a serious person can understand both even if he only actively uses one. That understanding alone makes him more dangerous than the person who keeps quoting old advice as though the structure had not changed. Because the structure has changed, the best companies stay private longer. The public indexes are more concentrated, private equity is working through an aging inventory problem, and millions of small businesses will change hands over the coming years in ways that public market-only investors are barely trained to notice. You do not have to buy a business next week to benefit from knowing that, but you do have to stop telling yourself that buying an index is the only intelligent way to think about ownership in 2026. It is one intelligent way, not the only one. That distinction may prove to be worth a great deal over the next decade. Because the people who build the most wealth are not always the ones with the best product. Very often they are the ones with the best map. And right now, the old public market-only map leaves out too much territory,